This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternatives marketplace and exploring topical issues. Today's guest is Kallum Pickering from Peel Hunt. Hello, Kallum.
Hi, good morning.
Morning. Right. Well, lovely to see you. I think, as always, we like to start off with a bit of history, career to date on yourself.
Oh, so I'm chief economist at Peel Hunt. I've been here since the summer. I've been in markets for almost 15 years. I cover advanced economies, big focus on UK. I also write a column for the Daily Telegraph. I've written for the Evening Standard. Had a piece in City AM this week, and I have a podcast called Macro Minds. And if you would like to follow me on Twitter, I'm also Kallum Pickering, all lowercase. And yeah, my expertise is not really, I would say, financial markets. For better or worse, I'm a macroeconomist. I care about monetary policy. I care about fiscal policy. I care about economic growth. But in the current world, it's almost entirely a macro-driven market, and so I find these views tend to be helpful and tend to be useful. And there's increasing interest. And I think on a day like today, when we find out we have a new president in the US, all of the questions are essentially macro.
Yeah,
exactly. And that leads us on to US election.
Yeah.
So looks like it might be Donald Trump as the new US president. Yep. Your thoughts? I know we were chatting sort of over the last few days, and you had a feeling that whoever came in, it was going to really have sort of similar impacts. But now that it looks like Trump, what are your...
That's right. Well, both candidates, Vice President Kamala Harris and the Democrats, and President Donald Trump, soon to be president for the second time, Donald Trump, have very different policy agendas. I mean, on the one hand, Harris had put forward a kind of expanded version of Bidenomics, but in some key issues had really lurched to the left, whether that was signals around things like price controls or taxing unrealized capital gain, like stuff that would really scare the market. Whereas with Trump, you had essentially an expanded version of his 2017 agenda on fiscal policy, which was controlled spending, but further tax cuts, whether that's extending the income tax cuts in the Tax Cuts and Jobs Act or a proposal to reduce corporation taxes. It's 21% the rate in the US. It pledges at least 15% for companies based in the US or 20% for all companies. But then trade tariffs and immigration controls. And my view was the US coming from 3 years of growth well above trend, like 3% annualized almost, which is really incredible. Even for the US, which is the biggest, most dynamic economy in the world, 3% growth is a huge number at full employment with inflation moderating. It's a huge achievement. And so from that position, it would be difficult for any president, even with the best policies, to maintain such strong growth. And so the danger is you have a slowdown in growth and then policy missteps which amplify that. The result of the election, at least tentatively, Trump is president. It's just a matter of time before that's called. Looks like the Republicans have the Senate.
Yep.
That's important for selection on the Supreme Court or key positions. The Fed chair, Jerome Powell, his term ends in 2026. Trump will have to select someone and then get that approved by the Senate. But also looks as if, might be wrong by the time this has come out, but I don't think so, looks like the Republicans also get the House of Representatives, and the House and Congress is necessary to pass fiscal legislation. So we probably have the full spectrum of Trump's policy agenda to deal with. So the good fiscal stuff and the somewhat scary, in many cases, trade stuff. But then on foreign policy, he's at least campaigned on an anti-war agenda. I think there are two-sided risks there. And so when we factor in all of these policies, there are still more questions than answers. But my hunch is just don't fight the market near term. The market's reacting with higher treasuries. Dollar is up a little bit, suggests a bit of a risk-off move, but also maybe fears of US inflation. But also equities are reacting positively.
Yeah. And is that your view that it's been priced in a little bit in the markets that we feel?
Yeah, I'm always looking for the orderliness of price moves. We get surprised by stuff all the time, and prices need to reflect that. So I, as an economist, don't really see a big deal that we have to engage in price discovery, even if it involves huge price changes. I tend to care about the orderliness of it, and at least so far the market reaction is orderly. And I mean, we were discussing before the podcast started about how the market has become used to these kind of events. Like, I remember Brexit being oh my God, what's actually happening? And David Cameron resigns, and I look at the market, and you just have huge volatility. Yeah. Everyone's trying to figure out, what does this actually mean? But then we've moved through a series of events with Brexit, the first Trump presidency, through COVID, the lockdowns, the Russian invasion of Ukraine, and now, actually, the market is just reacting roughly as you would expect it to. The only, I think, danger we have is the market may react positively on the hope of corporation tax cuts and deregulation and stronger US economic growth. And I think that's probably right. I think that knee-jerk reaction is probably right. What concerns me a little is Trump is inheriting a very different economy today than in 2017. Yeah. 2017, low interest rates, a low deficit, inflation under control, spare capacity in the US economy. Today, you have an economy which is at full employment. It's running a little hot. It's been growing above its potential. Interest rates are at more historically normal levels. The US has managed this with huge fiscal largesse, huge deficits, and the market so far remained relaxed. I worry that if we get everything that we could get on taxes, which would stimulate demand, and everything that we might fear on trade tariffs and immigration controls, Trump could create a huge imbalance by supporting demand and curtailing supply in an economy that's hot. And if the bond market starts to think this could be inflationary, then you might start to get some of these risk-on trades unravel. And for me, the key thing is the dollar. If the dollar's moving higher as treasury yields go up, I can say with reasonable confidence the market's just repricing higher rates for the Fed. That's fine. If the dollar weakens as bond yields rise, that's money flowing out of the US and potential fiscal credibility worries.
Right. And interesting, again, the conversation we had before the podcast started about the shocks we've seen in the world over the last X years, and how the reactions were a lot more severe than they are now, because they're almost become par for the norm now. These things are happening more regularly. What do you think the impacts potentially are for the UK, I guess, with Trump coming in? Because, historically, we've had good trade relations and, beyond trade relations with the US, a core partner for the UK. But we know Keir's not necessarily started off too well, sending over some of the Labour members to lobby for Harris. So where does this stand for the UK now, do you think?
Well, Trump seems to be an Anglophile. And we also know that he can fall out quickly, but he can also make friends quite quickly. And so I wouldn't worry too much that we set off from such a low base between Keir Starmer and Donald Trump that relations couldn't turn very positive. The way I would think about this is 2017. So of course we're always through this exercise of comparing Trump episode 2 to Trump episode 1. Trump episode 1, we were dealing with Brexit. That was our major problem, actually. So we're in a world where UK politics, even if we've got some policy issues, even if you say there are some anti-growth measures that Labour might have put forward, politics in the UK is kind of boring now. Kind of a low wattage version of John Major just lost an election to a boring version of Tony Blair. That's what the market cares about. It's the reason sterling has appreciated. So when I think about what this means, what the US election means for the UK, I think the initial market reaction gives us a useful guide, which is dollar's strong against everything today. That's a bit of a risk-off move. But sterling is also appreciating against the euro. And I'd have to check again, but I think the Japanese yen, which suggests the market is most worried about the most export-oriented and trade-oriented parts of the world. That's the Eurozone, it's China, and any economies that are linked to China, namely Japan in this case. Whereas the UK, even though we're an open economy, there's no reason, I think, at least initially, why Donald Trump would need to turn aggressive with the UK on trade policy. There's nothing obvious that he could win there. In the case of the Eurozone, you might say, well, America would like European countries to spend more on NATO, and so let's threaten trade tariffs as a way to bring them to the negotiating table. Or the US may say we have to pursue a more aggressive containment strategy with China, and maybe we should prosecute a trade war in order to do that. What's the advantage for the UK? In fact, actually, UK is probably too small to matter, which is probably key. And so we're in this environment where we have questions on foreign policy, questions on global trade and industrial production, and the UK looks like a relatively politically stable place with a bit of an economic growth upswing underway, and critically, an economy which is consumption-oriented and services-oriented and probably will benefit from a fiscal stimulus. And so I think there's scope, if UK politicians manage the relationship right, for the UK to be a bit of a safe haven over the next, say, 6 to 12 months as the market's trying to figure out what Trump might mean for global trade, production and international relations.
Yes, and I think that's something you and I have been discussing as well, in terms of, I know Charles Hall talked about outflows recently, and there've been a large number of outflows over the last few months. Well, and in terms of that, where do you feel, we know pensions, only 4% are actually invested in the UK, which is shocking. Yep. We talk about policies. We've obviously got a new government coming in. I guess it leads us to the budget and what your feelings are from what they've done in terms of the policies and where that leaves capital markets and investments into the UK.
Well, I fear I often give the impression I'm just like a blue-eyed optimist when it comes to the UK, but I feel I should qualify my view a little bit. It's not a stretch to think that after 4 years, which have involved enormous and highly unusual shocks. That's COVID, it's a Russian invasion of Ukraine and the gas shocks, along with all of the political noise that the UK has had, surge in inflation, sudden rise in interest rates and the adjustment to a more normal inflationary environment, that the glimpse we've had so far of this year, which is the weird stuff stops and the economy springs back to life, is probably the reasonable base case for the future. That is, short of another major shock, lower interest rates from the Bank of England, a more normal inflation environment, the fact that banks are well capitalized, households and businesses have got good balance sheets, can get us to what is normal economic growth for the UK, which my guess would be sort of 1.7, 1.8%. When I look at the budget, I think it's really split between what is a sensible policy, which is the debt finance public investment, which will add a lot to near-term economic growth. And it's important because the UK is chronically underinvested. We have rapid population. I mean, we're one of the few economies that doesn't have a major demographic challenge for the next 10 years. I mean, you look at the official estimates, we're going to have another 10 million people in this country over the next 25 years. It's roughly what we've had over the last 25 years. So you need infrastructure, you need housing, you need energy, and public investment has to play a role. So that's a sensible policy. And I think the adjustment on the fiscal rules to allow the government to shift its focus towards current spending and remove investment from the targets, I think that's sensible. But then on the other side, I think there are some concentrated costs to certain industries that will come from the increase in employer national insurance, the over-regulation of labour markets, excessive increases in minimum wages, the increase in capital gains. But net, all of this is offset by higher spending. And so the immediate effect will be over 2 or 3 years, a fiscal stimulus supporting an economy that's recovering, and an economy that's recovering can generally handle a bit of policy nonsense. I don't think we will see too much on the unemployment rate from minimum wage increases. I think all of these are going to be problems 5 or 6 years down the line when we have a recession and you find out you've overregulated the labour market and you've lifted your minimum wages up too high. I don't think this is going to be the near-term challenge. What we're yet to see from government is help on capital markets, and for them to actually put forward any legislation which meets their promise. And Prime Minister at the weekend in the FT wrote an article saying he was planning on deregulation, to actually deregulate markets. What we've seen is a plan to increase regulation in the labour market. We've seen government approve some stuff on planning, housing, but we're not yet seeing legislation which removes the huge indirect cost on companies coming from regulation. For now, we've just had the direct cost of tax increases.
And that's interesting because we've talked about, I know you've been speaking to people in the US and in Europe about potential investment now into the UK, seeing it really as undervalued compared to the rest of the marketplace. And I guess, it's really, where do you feel that now, is this going to be the catalyst perhaps, that if we do make some changes into capital markets, that might actually encourage investment in and remove these outflows?
Well, the UK had low valuations for good reason for a while after the Brexit vote. I mean, Brexit's not the end of the world. I mean, there's intelligent life outside of the EU. You know, some problems just take a few years to figure out. I mean, German reunification took 5 years to fix. The property crashes during the global financial crisis took 5 years to fix. Brexit's kind of a 5 to 10 year problem. We're at that horizon now where it doesn't matter much. But then once we started to resolve that, we had high inflation and no growth for a while, and so it made sense for investors not just to take money out of the UK, but to take money out of other parts of the world and pile it into the US. I mean, this is the key trade. We say money's coming out of the UK, but it's money going into the US. If I look at the net inflows into the US since 2010, it's almost $20 trillion. That's the UK market plus 50 other markets that have suffered. But now I think the UK is cheap, and by cheap I mean the prices are unjustifiably low. That's for all the reasons that we just discussed. But the question is, what gets the UK market going again? And I think we see some early positive signs. So I'm encouraged by the fact that sterling is appreciating. You know, we were against the dollar 107 in 2022 during the Truss budget, where we're trading at 129 today. Mm-hmm. We might be back to 130 by the end of the week once we wash out the US election adjustment. So we're trading at almost 2-year highs. 10-year yields are within that 2-year range. And what I notice from currencies is often currency moves front-run moves in risk markets, which makes sense, because if sterling is appreciating versus the dollar, almost by definition, someone's selling US asset, buying a UK asset. What we've not seen in UK risk markets is prices moving the way you'd expect. For instance, usually when you see sterling appreciate, you see the 250 outperform the 100, just because of the share of revenue for 250 favors a stronger dollar, whereas it becomes a headwind for the FTSE 100. But so far, the 100 has outperformed. It's okay, well, what's going on? People are asking me what I think is going on, and I wonder if, imagine the spectrum of risk assets. Let's say gold's over here and then Bitcoin's over here. UK equities were probably roughly in the middle, with the 100 more liquid and so a bit less risky. But the outflows have made our risk assets riskier and riskier and riskier. So it might just be that the initial bidding of risk in UK markets is on big cap first, where it's easier to sell. And then we'll see the normal relationship resume. The danger is, after so many years of outflows, with so many options for global investors, so many regions to think about, we might just need to see some outperformance in UK markets before global investors decide, let's move in. My view is this is the best environment to take on risk in the UK since 2015. When I speak to European investors, they sound more favourable towards the UK than they have since 2015. US investors have been so focused on the election, it's just not the right time to ask, let's get to the end of the year. What I would like to see is governments send signals that if the prices on their own do not justify inflows, we won't wait for long. We'll find policies to encourage, whether it's pension funds, insurers, to hold more UK equity, and then that should crowd in international inflows. And the process should be, I think, first, just sit down with them and say, we're backing you on growth, we've got a fiscal stimulus, we're going to do some deregulation, help us out, see what UK assets look attractive. If that doesn't work, you could shift to fiscal incentives, and then in an extreme scenario, you could mandate, but I would like to avoid that. I mean, part of the reason the UK is such a good market is that our capital markets are just open, and it's easy to move assets across, capital across the border.
Yeah.
It's interesting. I think we've mentioned it earlier on in this podcast and previous podcasts about the pensions and the really low allocation to UK equities, which is circa 4%. I think yesterday I read somewhere that it was a UK pension fund that was allocating 3% now to Bitcoin.
Yeah.
And you kind of think, hang on a minute, and going back to your risk spectrum where you've got Bitcoin at one end, gold at the other, UK equity somewhere in the middle, 3% to Bitcoin versus 4% to UK equity seems completely outsized to me. But there's obviously been this under allocation towards UK. We've got the Mansion House speech coming up later this month, and I know there's a lot of focus on the pension reform. Do you think, and again, going back, you mentioned this about mandating, do we want to see pensions mandated to put more into the UK, or what do you think could potentially come out of that?
Well, I think that we have had to deal with a succession of problems in the wake of the global financial crisis. So when I look at the UK economy, it's an economy which is still oriented to a world that no longer exists. So if you think about the good growth years for the UK when we had really healthy capital markets pre-GFC, we had a world that was radically trying to expand trade, international trade, and reduce trade barriers. We had a world that was becoming more financially liberal. Old foes were able to transact.
Yeah.
You had a huge peace dividend, which still existed, certainly through the 90s, but even a little bit in the early 2000s relative to now. Those three pillars have unwound, at least partly. We have higher trade barriers, we have had to increase financial market regulations, and at least, if it's too early to say we're shifting into a more multipolar world, we're moving into a world where the US no longer sees it in its self-interest to aggressively pursue trade liberalization. And so it's not using its economic size to encourage growth in the rest of the world. It's using its economic size to preserve its own interest in hegemony. So the UK is not set up for that world. And policy needs to adjust.
Interestingly, though, just on that, do you not think we are going to try and do that with the recent budget? And we've discussed, ideas of sort of AI being a huge area,
That's
innovation. Right. Is this an opportunity for Labour to potentially start to make some interesting changes?
Yeah. So the main thing is energy security in a world where you have geopolitical risks, but our best hope for productivity enhancement is AI, which is extremely energy hungry. But the reason I preface the argument about what policymakers should do with a look at the fundamentals is to say that it's quite seductive to think that if only you could bring the money into the UK, then you would get a healthy economic response. The fear is if you were to just force pension funds and insurers, let's take the extreme example, to force them to hold more UK active. Mark to market, we would get an increase in valuations, and the market might say, okay, this is fine, but it would be a mirage. We'd just be overvaluing assets. It would involve capital misallocation. For me, the best sustainable way is to make a judgment call about what the world looks like and the way the UK needs to be set up in that world, and then rely on the fact that our institutions are solid, rule of law is solid, we have reliable policy makers on the monetary side, we now have stable government, and the market should say this is a place where we can go and have protection against potential risks, whether that's geopolitics or energy price shocks, but we need to get our infrastructure and our energy right to do that. But if you've pursued all of those policies, and as a policymaker you say, okay, we've got the growth, we've got the security, we've got a 10 or 20-year plan for energy and infrastructure, and our markets are not moving, that's when you need to step in and do something to force the markets to move, because where I think the comparison between America and the UK is interesting for lots of reasons, but in a couple of ways, let me just highlight. First is we took the right lesson and the wrong lesson from the global financial crisis. The right lesson was fix the banks, fix household and business balance sheets, and you can tolerate a lot of pain. That's the evidence of the last 4 years. It's not been good, but it's been much better than the worst fears. It's because we have balance sheet strength. The wrong signal is that bubbles are bad. Actually, most bubbles in economics don't pop. It's bubbles that give you the railways and the energy revolution and the AI revolution. Clean up the mess afterwards, and America's just much better at that. It bailed out the banks, it fixed the balance sheets, and then it helped its economy grow. We didn't do the latter, so that's where we need an attitude change. The other thing, and it just goes back to your point around policy. Notice how the Americans always fix the supply side problems when they get them. So in the 1970s, OPEC inflicts 2 recessions upon America. America was a net energy importer, having been, in the early 20th century, a big net energy supplier. It supplied almost all of the Allies with oil during the Second World War, but it had this consumer boom and suddenly became a net importer of energy. And then OPEC inflicts 2 recessions upon the US and Europe. Europe finds another part of the world to buy energy from. America decides we're going to be energy independent and is now the big swing producer. In 2020, during the COVID dislocations, the major problem was chips. It's the reason we couldn't get cars, because we didn't have the chips. Who's the main supplier of chips? Taiwan. Oh, if we think for long enough, we can see why that might be a potential risk when we think about China foreign policy. Okay, well, America borrows $1 trillion. It sets up its trade policy to make sure it can bring chips manufacturing home. It fixes these supply problems. And that's why as a company looking to grow, you say, well, okay, I might like the UK, but what happens if something goes wrong in the world? I can still grow in the US. I can't grow in the UK because I can't get the energy. I'm vulnerable. So these are the policy challenges that we need to address. And if we address those, and I think this is what really matters for small companies, we can shift from a world where we're great at innovating, but we can turn those innovators into proper growth companies. Whereas now you say we innovate, we come up with a good idea, our institutions allow it, but then they decide they want to go to the US.
Yes.
Not because in the good years it's better in the US, but because in the bad years I still have the energy that I need to train my AI. In the UK, I might not be able to do that.
Yeah.
Which is really, I mean, that's an encouraging sign really for sort of venture capitalism now, to be able to start finding innovatory kind of sectors and start running with it, isn't it? And then if we can get the markets in place, we can see more IPOs and
That's
start to sort of more inflow coming in. It's really creating the right economic structure for which we haven't had, because we've had such a lack of stability, haven't we, in the UK? I mean, I guess to actually get a period when we have stable, possibly slightly boring economics and politics.
But I think it's looking long term as well, isn't it? You made a valid point there about the US, how it's looked at the problems and fixed the problems. We've got to start doing that, and we're looking at the Labour government with the energy, UK energy. All of these things, it can't be looking short term. You've got to look at these long term projects that are going to create this environment that supports and nurtures those companies to become the big growth companies, as you say.
That's exactly right. I mean, you can never have too much energy. I mean, one of the most reliable relationships in economics is energy consumption per capita and living standards per capita. We've become more energy efficient in this country, which is good, but part of that is because businesses have been forced to ration their energy consumption because of a lack of production. If we could produce more energy than we need, there'll be someone to sell it to. My view is if we could become energy independent and potentially even run energy surpluses, you would find that economic growth would be stronger, living standards would be higher. We would run smaller trade deficits, which would make us less vulnerable to currency market fluctuations. We would be providing insurance for our companies against a more geopolitically uncertain world. And in a way, the key thing in all of this is, in many respects, Britain is a highly advanced economy, but in other respects, we are no longer as advanced as we once were, and we're certainly not as advanced as we think. So in areas like energy and infrastructure and housing, our ability to just copy what is average performance in other parts of the advanced world would lead to huge economic gain. This is
Yeah.
really, really key. And that means we don't have to innovate or imagine ways to solve our problems. We just need to decide what problems we want to solve, decide which countries we might be able to imitate that solve that problem well, and then pass the legislation to do so. It's why it's great that our high-speed trains go faster than high-speed trains on the continent, but in the end, why have one high-speed train line when you could have 4 that all go a little bit slower, but might only cost the same amount? These are this is the humble reality that if we would just face it, we would find things would improve, I think.
Yes.
Which really comes down a lot to policy making now, doesn't it? I mean, that's really where the change is crucial.
It comes down to policy. In many ways, like in all the ways that someone living in the UK, I'm from Sheffield, so of course I'm a Yorkshireman. I like to moan about government. That's just in my nature. But there are lots of problems that we could fix if we got our act together. But there's also lots of ways that we're doing things right. And one way in which, and this is where I think I probably have a non-consensus view, is I think the UK political system, not the politicians, not the individuals, not the characters, the UK political system has done a much better job at dealing with, and I don't really like this phrase, but populism better than America and better than Europe. Much better. It's never been a question of changing the UK constitutional environment or changing the hardware of politics. It's always been a policy discussion, whether that's Brexit or Jeremy Corbyn and a shift to the left, or under Boris Johnson. We're in a world now where, after voting to leave the EU, we had a horrible compromise that no one's happy with, which suggests actually it is a compromise in such a close vote. And we have two political parties which have returned to what look like, if you were to close your eyes and take the average of the last 30 or 40 years, what policies would they come up with? You've basically got that. It's centre-right conservatism. It's centre-right Labour. We don't worry that Scotland might leave the UK anymore. The UK-EU relationship will gradually turn more positive. The UK is basically reverted to what is a historically stable mean, whereas in the US, it's still a high-pressure political environment where we're now trying to figure out what a zig or a zag might mean in policy for the US. If I look on continental Europe, Germany has problems, France has problems. So our political system has managed to digest populism and move on in a way that other places haven't. And it only stands to reason that there'll be economic benefits from that. But it also means that this opportunity, now that the political environment has simmered down, allows us maybe to address some of these problems. Because if you have rapid population growth and you don't provide the infrastructure, and you don't provide the housing, and you don't provide the energy, and people face real indignities that come from the pressure on those systems. And so can we use this window of political stability to solve some of these problems? I hope we can. I think we probably will, actually. I'm an optimist. I think we've got good institutions. And I think we should and I think this is what markets are doing, just compare ourselves to some other parts of the world today versus where we were 3 or 4 years ago. And even if we're a little bit frustrated about some of the budget measures, we can easily understand why sterling is appreciating and why attitudes towards the UK are improving, because everything in markets is relative. And we've moved from being a high-risk, low-growth place to a less risky, higher-growth place, while other parts of the world have gone in the opposite direction.
Now, that actually, interestingly, leads us on to AIM,
Yeah.
where we are obviously, Growth Invest, a bit more focused on. We had the inheritance tax, new restrictions with business relief going to 20%. Your thoughts? I know Peel Hunt are pretty involved in this AIM market. What are your thoughts on this? And obviously, the market reacted more positively because I think everyone was expecting it to be abolished.
I suppose that's just that you didn't have to go through a wave of forced selling to stay in line with consumer duties. Let's start with the economics of it. It's easy to understand why, politically, things like inheritance taxes or taxes on investment are attractive. No question. You see why people are persuaded by those policies, but we have to be really clear about the economics here, which is that our nature is to value our children's consumption more than we value our own. This is why parents with kids that have significant higher living standards are still desperate to leave houses behind and savings behind. But, everything that you see, all of the capital stock is essentially, to put it really plainly, it's been left behind by dead people that want us to have a better standard of living. Yeah. And we at our peril try to redesign economies and shift incentives, and often it backfires in their unintended consequences. And so the short-term political incentives to tax inheritance or capital need to be understood in context of the fact that to be in a relatively well-off, safe place is a historical exception. The wealth is the anomaly. The poverty and the destitution that we've seen through history and around the world, that's baseline. It almost requires no explanation. That was what you expect. And this is really an important part of understanding why that's the case, because with things like property rights, people feel confident that they can leave something behind. And so I don't like the economics of taxing inheritance, even if politically it might make sense. I think it's a dangerous policy. And I think for an economy that's underinvested, taxing anything that can deter investment is bad. I mean, taxes on sugar and alcohol reduce consumption of sugar and alcohol. Same works for capital investment. You tax inheritance, you incentivize people to liquidate their assets and spend it on frivolous consumption. That will happen. So that's the danger. But, and again, I try my best to give this to give the new government its due. It could have gone further with inheritance taxes. It could have gone further with capital gains. And that fits with the idea that they're trying to balance the politics with the economic costs of some of these policies. What I think we need to see is an overarching solution to the outflows problem. Because if you consider what government has said so far on its key aims, ease the restrictions in the housing market. We've seen some of that already. Boost public investment. We saw that at the budget. Help capital markets. Well, so far we've had the end of the UK ISA. We've had higher capital gains tax, and we've had half of the inheritance tax relief on AIM being removed. But keep in mind that there's always a negotiation taking place between government and civil service. And in this case, it will be government with Treasury, where if government says to Treasury, we would like to set up some policies and some incentives, and they'll be speaking to the regulator to try and fix this outflows problem. The Treasury will say, okay, well, we've already got more stuff on our plate than we can possibly manage. You need to make our life a little bit easier. So government will say, well, which policies don't you like? And it might be the case that Treasury says, and I'm just guessing here, but this is the kind of conversation policymakers will have. Well, actually, you're not increasing savings or investment with the UK ISA. You're just spreading out the existing pool. So why don't you get rid of that? And then we don't have to manage that anymore. That takes off an administrative burden. So we might be on a journey towards government actually providing a good solution, but all of the signals along the way are negative. It's why government just needs to get its communication right and come out and say, don't worry, we have on an 18-month horizon a big solution here. And then the market would take that well.
The problem is consumers and people don't look for that long term. They're looking for the here and now, and they're voting on that here and now. And I think the Trump, you look at what's happening there with immigration, and he played that card massively in the build up to the election, and we see that here as well. People are very here and now. I want this, and they're not forward looking enough. Whereas going back to the energy issue we talked about earlier, we've got to think about these long term plans and get people to buy into them.
That's exactly right. I mean, this is why I think the government actually did quite a good job. Of course, you should ask me what I think about the market reaction last Thursday at getting the market to swallow significant borrowing in order for public investment, because for the reasons that you mentioned, it will be quite difficult to put even more taxes upon people in order to finance public investment, or to say, we're going to cut, say, NHS or education spending or some other spending in order to finance public investment. And so the solution to that contradiction between your long-term objectives and your short-term political desires is borrowing. Yeah. Really, that's the solution. That's the way to say, well, we don't have to raise your taxes, but we can spend money where we need to. And Reeves and the Labour government did a good job at bringing international institutions, the IMF, the OECD, on board, getting the independent scoring office, the OBR, to essentially validate plans for higher investment and borrowing to do so. And then we saw Mario Draghi, ex-ECB, the top European technocrat. He's the European equivalent of Alan Greenspan, right? I mean, he's considered a kind of a guru, a sensible voice. Came out and said this is the way to do it. That maybe we should imitate the UK. And so I think this is the thing that we should be focusing on. And noticing, when was the last time we had not just a senior European technocrat, but possibly the most respected senior European technocrat say, what we should do on the continent is start to imitate the UK. This is the kind of thing you get pre-Brexit, where we were a more growth-friendly, market-oriented economy, and Europe was struggling with economic problems. If we could be a little bit more like the UK, we've been the example in Europe of what not to do. Suddenly now we're becoming the example of what you might want to do. I think we need to put some of our maybe personal frustrations about the budget to one side and say we're actually in international markets here, like net balance. This is probably good stuff, but it has to be followed up, right? We need to see the energy investment. We can't just see capital replacement in energy production that doesn't get us more energy. That's a bad outcome. We can't see government crowbarring higher current spending and call it capital spending in order to spend more on whatever it wants to spend money on. This we need follow-ups, but the signals I think are actually quite positive. Maybe the good way to wrap this up is the 2016 to 2023 was an exception for the UK, where we had unusual external supply shocks, unusual domestic political problems that we've worked through. And now we're in a world where I think on many cases we reverted to mean. Mm-hmm. If my growth forecasts are kind of 1.7 to 1.9 for the next couple of years, and the market's moving in that direction, which I think is good, I sound like a wild optimist, having faced almost no growth for a few years. But if we could only rewind 10 years ago, and I said, actually, I think we're going to get 1.7, 1.8% growth, and the Bank of England's going to help us with rate cuts, and we've got a bit of a fiscal stimulus. Well, that's not very exciting. No. But from where we are, I think it is.
It is, yeah.
And I think we're returning to our more normal position, which is we're a mid-Atlantic economy. It's impossible to keep up with the US. The US is expensive for a reason. But we can look a bit more like the US in a European context. Mm-hmm. And that's where, the lazy economist should say, what's my growth forecast for the Eurozone? What's my growth forecast for the US? I'll take the average and add a bit, and that gives me the UK. That's not where we were between 2016 and 2023. Yeah. If you look at the numbers so far this year, that's almost exactly where we are.
Which is very positive.
Which is very positive. Yeah. And I don't need to do intellectual backflips to think that can continue.
Yes.
Yeah.
That's the key thing for me.
Yeah.
Well, it's been absolutely brilliant. Thank
pleasure.
You so much, Kallum, on a day that's been quite exciting. And we hope to get you back on soon.
Oh, I'd love to join you, yeah. Perfect. I don't struggle for the production of words, so I'm happy to chat economics.
Super informative for everyone today. Really good. Thank you.
Brilliant. All right. Thank you very much, Kallum.
Thank you.
To hear more, tune in to either YouTube on video or all good podcast channels.